So let's get this show on the road. If you don't have it already, I'll put it in the chat once again. We have a few questions that we're going to cover today. And I mean, it's a fun chapter. Chapter 5 is actually pretty straightforward, not very difficult as long as you know what to do. And we're going to spend the first 30 to hour or so kind of like trying to making sense of it. And I think we'll be able to do a good job. So that's all that matters here. So it's going to be a little bit more prepared than our last session. There's a lot of stuff that I think once we can put it in perspective, it makes quite a bit of sense. So it'll be fun. So yeah, we'll do that. All right. So the classic theory stuff. Okay. So let's get it going. So what in the hell is a statement of cash flows, right? Why is a statement of cash flow important? What does it mean? How do we make sense of it? Blah, blah, blah. And before we begin, I'd like to share that a statement of cash flow is really what it's all about. It's a way for anybody, okay, anybody to have a sense of how cash is literally moving within a company at a specific point in time. And you're going to see what I mean. And the reason why a statement of cash flow is relevant is because sometimes a statement of earnings doesn't show you the actual picture of your cash, right? Can everybody agree here that ideally in a world that's perfect, our profits should be equal to the cash we'll have, right? Does that make sense? Like profit should be equal to cash, yes or no? Like in an ideal world. Yeah, okay, right? That's what it's supposed to be. Unfortunately, actually before that, where do we see profit? In which statement? There's 3 statements. In which one do we see it? Where do we see profit? Like, it's like its whole thing. Where do we see earnings? In which statement do we see earnings? Earnings or profit? Like it's literally in the name. Okay, cool. So I think we could all agree that we see profits, i.e. earnings, in our statement of earnings, right? In an ideal world, profits should be equal to cash. The problem is that, unfortunately, the statement of earnings doesn't always give us a big picture, the right picture of actually the amount of cash we made within that period. So what we're going to do now is we're going to actually go through an example to try to make sense of what is this idea of relevancy for our statement of cash flow and why is that the case. So the first exercise we're going to do today is we're going to try to argue and prove why a statement of cash flows give us a better understanding of the actual cash that's being moved within a company. So you'll see exactly what I mean in a second. So this will take not too long. I'll try to not spend more than 5 minutes on this specific, I'll say 10 minutes on this specific idea. Okay, so let's say that we're looking at Netflix, okay? And we're gonna look at their statement of earnings. And we're going to say for the year ended December 31st, 2020. All right, the classic stuff, super easy. We've seen this before. We like this stuff. So what we're going to do here is we're going to say that sales, right, was equal to, we'll call it 50 million. All right, so we have sales of 50 million. I'm gonna do this. We have sales of 50 million. So we have cost of sales of, call it, divided by 2, so 25 million. So we're gonna have our gross margin. It's gonna be equal to, okay. You'll see why this is important stuff in just a bit. All right. So we have our gross margin. It's the cool stuff. We have pretty much this right here. Then we could look at operating expenses. And we're going to look at 2 different scenarios, 2 different statement of earnings. And you'll see why this is relevant in just a second. So we're going to have our operating expenses. We're going to put it like this. We're going to have, call it wages expense. We're going to have rent expense. And we're going to have depreciation expense. So these are going to be two different scenarios, and this is going to be equal to, call it, for 150,000, this will be equal to 230,000, and this here will be equal to 0, all right? Such that our operating income, whoops, will be equal to, there we go, such that our operating income would be equal to, could somebody tell me what our operating income will be equal to? What will that be equal to? If we have $25 million in wages, in gross margin, and actually we'll make this 4.5. So this minus this and this, what would that give us? What would that give us? Just to make it interactive, at least. Somebody wants to do it. If not, in 10 seconds, I'll just press the button myself. Cool, thank you. All right, amazing stuff, really good stuff. Okay, so now we have our operating income. And now we're going to assume that we have our income tax at 50%, because we'll do it 10%. At 10%, what would be our income tax in this case? Well, it'll just be this times 0.1. All right, and now we're going to have our net earnings. This would be equal to this minus this. Okay, so this is our first scenario. This is a scenario in which we don't have any depreciation, and we really want to highlight these two numbers here. They're going to be very important. All right, so we're going to do the same thing once again. All right, I'm going to do this twice, and you'll see why this matters. Okay, so now let's make our depreciation expense equal to the following. Can somebody tell me what's my operating income? If we have now a depreciation expense of $1.5 million. What would be our operating income? If that is our number. Nice. Cool. Okay, so first thing that I want to really express with everybody here, and we're doing pretty good on time, so I'm happy about that. So can everybody see that our income tax, and we're going to call this Netflix A, we're going to call this Netflix B, like two different scenarios. Okay, can everybody agree that our income tax on Netflix A is bigger than our income tax in Netflix B? Can everybody agree that that's the case? Just say yes or no in the chat. Okay, so income tax, we're paying much more taxes in scenario A versus scenario B. However, could we agree that our net earnings, right, are bigger in scenario A than in scenario B? Is that the case? Yes or no? Okay, that's the first thing that I wanted to share. Okay, so in both cases, we know that here, we're going to write it here. Okay, we're going to put it here. We're going to write income tax bigger in A, and we're going to write net earnings bigger in A. So then let me ask y'all this. In what scenario would you rather be? Would you rather be if you would, like, let's say you would get all the net earnings in your pockets, wired in your bank account immediately, okay? Which scenario would you rather be in? Either scenario A or scenario B? Just like this. Everybody would rather be in scenario A. So everybody says scenario A. And if you don't mind me asking, why would you rather be in scenario A? Because it makes more cash? Would that be a fair point? More earnings? Okay, cool. More earnings on the statement of cash flows. I mean, of earnings. Okay. And I think these are all very fair points. I think these are all very, 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 very fair points. Okay. So just to bring it back, we said income taxes are higher in scenario A, but our net earnings are bigger in scenario A. And for that reason, we would all rather scenario A, right? Because it seems like we're making more earnings. Okay. Well, what's funny here is that that's actually true. We are making more earnings, but we actually have less cash in scenario A. And I'll tell you why. And that's why the statements of cash flows, it's so crucial and important to understand what's actually happening to our cash. So before we get there, we're going to define two things. We're going to define C as being a cash expense, and we're going to define NC as being a non-cash expense. All right. Now, really quickly, can we all agree here that these three statements, like these wages expense, rent expense, and depreciation expense, are the only expenses that we have? I think we could all agree to that. So now what we're going to do is we're just quickly going to define whether they are a cash expense or a non-cash expense. So wages expense, is it a cash or non-cash expense? If you could write it in the chat, just write C or NC. Is it C or NC? Wages expense. Okay. Yeah, it's a cash expense because literally, if your employees, right, they finish the year, they're going to want what they're owed. They're going to want their wages, right? Imagine you went to go to work at, I don't know, McDonald's and they just didn't pay you for a week. That would suck. So wages expense is definitely a cash expense. Then what about rent expense? Is it C or NC? Which one? Amazing. Now this is where it gets interesting. What about depreciation expense? Is it C or NC? Exactly. Depreciation expense is kind of like fairy dust. Like it's something that you put in your statement of earnings. It's an expense that we actually like journal, but it's not an actual it's not an actual cash expense. You don't go to anybody and say, you know what, here's $20 for my depreciation expense. That literally never happens. It doesn't happen. And depreciation expense is a literal non-cash expense. And for that reason, as you can see, because depreciation expense can be a big amount, it's actually going to make us have a smaller net earnings. Can everybody see that? That because we have depreciation expense, we have smaller net earnings? Yes or no? Yeah, 100%. However, technically, we never really spent that $1.5 million. We never did, right? So technically, in this scenario, we should be having this much in our cash pockets, right? Because we should take our net earnings plus the amount we actually never spent, that we said we spent. Do we all agree that this should be what we actually have in our bank account as for cash? Quick why if it's the case. Everybody sees like yes, this is a yes. We see that this should be what's in our bank account. Okay, so knowing that, would you rather be in scenario A or would you rather be in scenario B? Which one has the most earnings? Exactly. We would rather be in scenario B because we're actually making much more cash. Now, this is a very important thing to understand because our statement of earnings and our income statement, the same thing, they don't really represent how much cash we have on hand after a specific accounting period. And that's why it's extremely important to vet whether there are any non-cash expenses shared within that statement of earnings, because we won't get the big picture. We won't get the correct picture of the amount of cash we have. And that's why the statements of cash flows is so important. Now, before we move on, do we understand the exercise we just did? Does this make sense? Do we see why the statements of cash flows is so important? Yes or no? Okay, good stuff. Any questions? Any questions? Because this is the first part of our session. I wanted to cover that. Any questions, yes or no? Or can I move on? I think we're good. Cool, amazing stuff. Okay, so now that we understand this, we understand the value of what we call a statement of earnings. We're super stoked, we're super happy. Now what I would like to do is I'd like to give you a little bit more context on what a statements of cash flows is like. What does it look like? You know, what is that all about? So that's what we're going to do now. We're just going to try to walk through a statement of cash flows. And by the way, the reason why I took this time to kind of just cover the rationale is for two reasons. Three, actually. The first one is that on the exam, there are multiple choice questions. You may see this as a multiple choice right? Something not similar like this, but with the same idea. Two is that most of you all want to have super great jobs, and I think you're all superstars and you'll be able to. But this is actually what we call an interview question. How do we actually see the effect of depreciation expense on our cash for a company? Really, really important stuff. And also in the future, when you do your own taxes, if you ever want to, you'll need to understand this. Anyways, that said, now we could try to get a better sense of a statement of cash flows. So what's cool with a statement of cash flows is that it's actually broken down into three parts, right? In our statement of cash flows, we just want to look at our operating activities. We want to look at our financing activities. We want to look at our investing activities. The real order, I kind of messed it up, but the real order is operating activities, investing activities, and financing activities. We want to look at these three buckets. And what we're going to do now is we're going to kind of create a table together, okay? And we're going to try to break down what this could actually mean, okay? So our statement of earnings will be broken down, we're going to call this title, into operating activities. We're going to look at investing activities. It's going to lap. And then we're going to look at financing activities. Right, so we have three different buckets. Now, what I'd like to say here is we're going to try to build like a little definition, nothing too super extensive, but it should give you a little bit more color on the idea. Okay, so operating activities, we're really looking at immediate operations of the firm. Okay, so we could write the firm's immediate business operations, i.e., so this is within the next year. So 1 year of business operations. All right, so nothing too crazy. I think I'm going to move this at the bottom, actually. Sorry about that, guys, just to make it neater. Move this here. But yeah, so really quick, that's the idea here. Operational activities are pretty straightforward. It's the firm's immediate business operations. You could think of it as being really essentially anything related to what the firm does to conduct its business. Okay, so immediate business operations. We want to think about it as what the firm does. Okay, we could really just write it as being just that. Sorry, I'm just thinking about how I'm formatting this. But investing activities, essentially what you want to look at when we're thinking about investing activities, you're really trying to get a sense of what is the company doing in terms of investments to further its business operations in the future or to create shareholder wealth. Now, this is a lot of like big words, but when we're thinking about investing activities, we're thinking about long-term assets, okay? So what I'm going to do here as well is I'm going to write account recalls. So key accounts, key category of accounts. And then here we're going to look at key accounts in specific, just so when you're doing these questions, you'll have something to look at. So here we're looking at non-current assets. Now, when we're thinking about non-current assets, we're thinking about land, equipment, long-term investments, and things of that nature, okay? So land, equipment, building, and long-term investments. It could be more. Could be more. So that's typically what we're looking into. Now, just for us to be able to keep that same energy, we're going to do the same thing with our operating activities. So when we're looking at operating activities, we're looking at current assets and current liabilities. However, as we mentioned before, we're also going to look at a few other things. Look at net income and then non-cash expenses. So that's really super important. Now, in financing activities, what we're looking at, and I'll do a summary because I'm kind of going all over the place, but when we're looking at financing activities, we just want to look at, as we did with our previous chapters, how is the company raising money? And the company could raise money into two ways, either through equity or through debt. So we're literally only looking at issuance of shares or dividend payments, or a notes payable issuance, or a note payable payment. Okay, really two things. Okay, so raising money through equity financing or debt financing. All right. Really super important. And here you're going to be looking at long-term liabilities, and we're going to look at shareholders' equity. All right. And within this bucket of category of accounts, we could look at bond issuances, we could look at notes payables, we could look at dividend payments, and we could look at shares issuance. All right, so now that I talked like an idiot for too long, I'm going to tell y'all like the big picture. Sorry about kind of being all over the place. So yeah, now that we have all this information, let's go back into it. So a statement of cash flows could really have only three things. It could have operating activities, investing activities, and financing activities, right? These are the main things that are actually going to affect money, right? Your operations for your business on a day-to-day basis will affect your cash. Your investing activities, well, if you want to buy a new property, if you want to buy new machinery, it's going to actually affect your cash. And then with financing activities, well, you want to raise money. That means more cash. You want to essentially pay your shareholders. That means involving cash as well. So there are three activities. All right. Now, the idea of what we want to look at is we're going to want to look at categories of accounts. And each statement of cash flows will have different accounts, right? Different things that you need to probe. But in general, this is why category of accounts are pretty interesting. Okay. So for operating activities, you want to look at current assets, current liabilities, net income, and non-cash expenses. The reason why you want to look at that is because we know that net income is literally our cash that may not be adjusted, and we know that we must adjust for non-cash expenses. I talked a lot, so really quickly, could you tell me in the chat what are a few examples? And there's only a few that are non-cash expenses. We looked at one already, but you could also include that. So what are examples of non-cash expenses? Okay, so depreciation, what else? Okay, what else? That's good. Amort. What else you got? Is there something else that is maybe not necessarily a cash expense? Something that we see in our statement of earnings, something that we also saw in chapter 8 when we sold equipment or something of the sort, and in chapter 10 when we actually looked at our premiums and our discounts on bonds payable. What have we seen? There you go. Perfect. Okay, so that's really good stuff. These are the main accounts that we're going to look at in terms of non-cash expenses. All right, so that's super important. So in this case, what we're going to do here, I'm just going to format this better. Perfect. So key accounts that we want to look at are key like non-cash expenses that we have are depreciation, amort, gain, and or losses. It's typically what we're looking at. Okay. So now that we know we have these different categories of accounts, we could kind of go deeper into key accounts. For operating activities, we're kind of going to make it fun. What are current assets that you'll typically see? What are current assets that we typically see? We see accounts receivables. What else? We see inventory. We see merchandise. We see prepaid expenses. And then for current liabilities, we have accounts payables. What else do we have for what's another current liability? We have accrued liabilities, and it's typically something around that end. All right, so that's typically how it goes. All right, so now we understand that there's three types of activities that we want to look at. We understand why they actually exist. We understand how we could identify them through categories of accounts. And then we also know the key accounts. All right, so that's pretty straightforward. Now, let me see here is we're going to define a nuance. Okay, we're going to define a nuance. Do you guys know about the direct and indirect method for our operating activities? There's two ways for us to actually pinpoint that, our direct method and our indirect method. All right. Do you guys have you guys seen that? Does that make sense? Yeah, 100%. Okay, perfect. Amazing stuff. Good stuff. Okay. So there's two ways. So you could compute your cash flows from operating activities in two ways, direct or indirect method, right? But what's really cool here is that there's actually only one single way to do our investing activities and one single way to do our financing activities. So always the same. You could say no nuance. No nuance. So that's really the only key thing that we want to look at. So what I'd like to say here is that the direct and indirect method is something that we're going to dive really deep in today. But when you're thinking about your investing activities section and your financing activities sections, you really have nothing to worry about because it's really straightforward. For example, let me ask you a question. Let's say Netflix bought $50,000 worth of land. Will that be a positive sign or a negative sign in our investing activities in our statements of cash flows? What would that look like if you'd have to kind of guess or think about an answer? So if Netflix purchased land for $50,000 in their investing activities, would that be a positive sign or a negative sign? What do you think? Exactly. It would be negative, right? Because it's literally as we would think. It's a payment that they made. It's as simple as that. You shouldn't have to think about it more than that, to be honest with you. It's really as simple as that. So for that reason, it'd be as simple as that. All right. So what I'm going to do is I'm just going to create a little statement of cash flows such that you guys can visualize all the spiel that I'm sharing. So it'll be a little bit easier. All right. So we could have our cash flows from operating activities. Then we're going to have our financing activities. All right. So the idea here is that we could have three different sections, right? We could have our operating activities and we could have our investing activities, okay? And our financing activities. Now, the idea here is that there's really no nuance with our investing activities. It's literally as you would think. And the same thing goes with our financing activities. Let me give you another example and we'll put it in our little table, all right? Let's say Netflix paid dividends, okay, of $20,000. Would that be a positive sign or a negative sign in our statement of cash flows? If Netflix paid dividends of $20,000, what would that be? Right, just from the perspective of, is there a nuance here? If Netflix paid a dividends of $20,000, would that be a positive sign or a negative sign in your statement of cash flows? If we also said that there's no nuances, the investing activities and financing activities section of your statement of cash flows is literally as you would think it would be. It's very straightforward. So would this be a negative amount? Would this be just 20,000? Or would this be minus 20,000? Which one would it be? Perfect. Amazing. Yeah, it would be negative, right? Because they paid a dividend. They are paying money. All right. So let's kind of go with these examples. It's going to be pretty interesting stuff. All right, so Netflix paid a dividends of $20,000. Let's go back to another example. Let's say Netflix bought land for $400,000. Would this sign be negative 400,000 or would it be positive 400,000? They bought land for $400,000. What would happen here? I think people wrote in the chat. Yeah. So yeah, it would be negative 100%. Okay. And finally, this is where it gets interesting. Let's say that accounts receivables for Netflix. Okay. So they had accounts receivables. They had 2020 and then 2021. Let me give you an example. We're kind of like freestyling it, but let's say this is the case, and then let's say, okay. Let's go. Okay, so this is accounts receivables. All right. And we know that in our statement of cash flows, we need to look at, okay, we need to look at a different nuance here. And let's assume we're using the indirect method. And I'm going to go deeper into it. I'm just kind of having fun here. I think we're working on something good. So let's say we're using the indirect method, okay? And Netflix, their accounts receivables went from $43,000 to $30,000, all right? What should we write here? Should we write increase or decrease in accounts receivable? What should we do? Is this an increase or a decrease in accounts receivables? What do y'all think? 43,000 to $30,000. Did our accounts receivable increase or decrease? What happened to our accounts receivables? The date. It was 43,000. Oh, my bad. Y'all okay? Y'all right. My bad. Let's do it one more time. 2020 to 2021. What happens? Sorry about that. I was so confused. I was like, why are they saying this? So yeah, decrease. Sorry about that. So yeah, it would be a decrease in accounts receivables. Okay. Now the decrease, can somebody tell me in the chat, is by how much? How much are we decreasing our accounts receivable by? 13,000. Okay. So do we put 13,000? Do we put minus 13,000 or do we put plus 13,000? What would we do? Is it a negative or a plus sign? So I see one positive. What do y'all think? Is this a negative or a plus sign? What would we do here? I need 2 more answers, just for fun. I see 2 answers that are saying positive. I would like to see 1 more answer, if anything. One more. Hussein, what do you think it is? And Juliana, positive. Okay, amazing. So yeah, the answer here would be positive, right? It'd be positive. But now it's like, well, why in the hell would these be positive? Okay. And this was my very unsmooth way to try to bring y'all to my keynotes for how do we go through our indirect and direct methods. What are the key things to follow? This was my very unsmooth way of doing so. All right. And we're going to do just that now. So now I'm kind of just going to walk you through a little table that'll tell you exactly what you want to do for these 3 different sections of your statement of cash flows. It's just my very unsmooth way. And what I'd like to say here, and we're going to see if it's clear. So obviously with our operating activities, there's something that's not too clear. We're not sure whether our signs should be positive or negative. Do we all agree? We're not too sure whether it should be positive or negative. So we need to understand further some methods, okay? I think we could all agree that's the case. But when we look at our investing activities in our statements of cash flows, I think we could all agree that it's pretty straightforward. Whatever is happening, we write into our statements of cash flows. So if it's a sale, then it's positive. If it's a purchase, then it has to be negative. Does that make sense for our investing activities? Cool. Then for our financing activities, we understand that if we're getting money, it should be positive. And if we're paying money, it should be negative. Are we all okay with that? Any questions before we go on? Because I'm kind of freestyling a little bit. Any questions before I tell y'all exactly what to do in all scenarios? I think we're chilling. Cool. All right, so we have our operating activities, okay? Now, what we're going to try to see here is we're going to try to understand, well, what happens for our operating activities for these different accounts. So we're going to have accounts here. So we're going to have our current assets, net income, non-cash expenses. Okay. Okay, so can we all agree that these are the different accounts that we would see in our operating activities section? We would see net income, non-cash expenses, current assets, and current liabilities, right? Do we all agree that's the case? Yes or no? Amazing. Good stuff. Okay, cool. So with that, we're going to try to create a quick walkthrough and we're going to understand what happens in these different scenarios. All right, sounds good. Okay, so now what we're going to try to see is how do we put this in the statement of cash flows. This is exactly what we're going to try to uncover. So if we have a net income of $900,000, okay? If we have net income of $900,000, something of the sort, how would we include this in our statement of cash flows, right? We would put net income right here. But would this be a negative sign? Would this be a positive sign? Or would we just write it as is? So there's three answers that we could say. So positive or negative? If net income is 100, if this is our net income, how should we put it into our statement of cash flows? As a positive or as a negative? What do we think? If we're using the indirect method, which is going to be the most common way of us doing our exams. You're only typically going to look at the indirect method. So if this is our net income, should we put it as a positive sign or as a negative sign? I see only one answer. Yeah, so it would be positive. So we would literally just do this. Okay. What about non-cash expense? Do we put it as a positive or do we put it as a negative? What about non-cash expenses? If we go back to what we looked at in our first example, are non-cash expenses going to be added as a positive or as a negative? Okay, good, amazing. No, so it would actually be as a positive. The reason why it would be as a positive is because we want to add that back to the cash we lost. Remember what we did here? We took this amount and we added back the depreciation expense because we know that that's money that we kind of said we didn't have, but we actually did earn that money. So we need to add back depreciation expense to our net earnings. So non-cash expenses, we always need to add back, okay? So positive. And we're going to put Y here. Add money lost to our net income. Right? And I'm going to stop being annoying. I'm kind of just going to share some ideas here. So in terms of our current assets are super interesting. And essentially, all the current assets that we have, okay, if our current assets are increasing, right? Or yeah, if they're increasing from one year to another, as you can see here for inventory, if they're increasing from one year to another, what you want to be able to do is you want to say if our increase in our assets is happening, it means that we need to put it as a negative in our statements of cash flow. So if current assets are increasing, so if increasing, negative in SCF, all right, and if decreasing, positive in SCF. Now, a really good way to understand why, if our current assets are increasing, we should put a negative amount in our statements of cash flows is super interesting. Well, let's say that we had, in this case, inventory of $43,000. So we had $43,000 worth of phones, right? But in the next year, we have $90,000 worth of phones. It means that we have more phones in our company, in our inventory. So by definition, we don't get phones for free. We need to buy these phones. And those phones had a cost, right? Which is what we put into our statement of financial position. So that change in inventory from 2020 to 2021 is exactly what amount of cash we lost within that year, because we had to pay for that inventory somehow or another. Does that make sense? Do we understand why, if it increases, well, it means that we had to pay for it. So by definition, it means that we lost cash. And if it's decreasing, that means that we received cash because we probably made a sale of that inventory. Do those cues make sense? Okay, perfect. Amazing. So by definition, that is why all of our current assets, if they're increasing, it probably means that we had to spend money for it. And if our current assets are decreasing, that probably means that we made money off it. Okay, that's the idea. And don't worry, all of these like little notes and ideas, I'm going to put it into our course pack, like a Word doc, like I did for chapter 10. So you'll be able to read through it. Now for current liabilities, it's really interesting. It's the same idea. So if our current liabilities is increasing, so if increasing, let me just put it like this. So if CA is increasing, it means it's positive in our statements of cash flows. And if our CA is decreasing, it means it's negative in our statements of cash flows. So now we want to understand what this means. All right. So if, for example, we would go here and we would call this accounts payables, and it was 90,000, and here was the following amount. So let's say we had accounts payables of 129,999, and we had in 2020, and we had accounts payables of $90,000, right, in 2021. So what does this mean? Does this mean that our accounts payable increased or decreased? What happened there? Nice, okay, exactly. So it decreased. Our accounts payable decreased, okay? Now, for an accounts payable to decrease, this means that we had to pay out our suppliers, right? So if we have less accounts payables, that means that we spent more money because we had to pay out what we owed. And for that reason, if we paid out what we owed, that means that we spent cash. And for that reason, cash is actually less, right? We lost cash in that endeavor. Same idea goes with if our current liabilities are increasing. For example, if they were increasing, that means that we're paying less cash, right? That means that we paid less cash than we were supposed to. For that definition, we could add that back to our statement of cash flows. So that's really all there is to it when it comes to this idea of how do we go about, right? How do we go about doing this? It's as simple as that. Now, in terms of our operating activities and in terms of our investing activities and financing activities, it's, as we said, it's as easy as that. So we don't have to worry about that too much. So it seems that we're all kind of, you know, not into it too much. So what I'll say is let's take a little 5 minutes, or yeah, let's take a little 8 minutes break, and we're going to come back into this a little bit more energized, and maybe we'll be able to like really have fun with our 3 problems here. So we have 3 cool problems. They're all, as I said, in the Excel, and we're going to look at the different nuances instead of kind of talking in vain here. We're gonna try to maybe explain theory as we do problems instead. Maybe that could be a little bit more conductive to our session. So yeah, let's take a quick 8-minute break and we're gonna jump into problem 1. Let's do that. Okay, are we stoked or are we stoked? Are we excited or what? Are we excited to all give it a shot to this specific problem one? It's a fun one. Some of you may have already done it, but it's a pretty good one. We're going to use it as a basis to establish the theories and kind of maybe learn as we build our boat type of thing. You know what I'm saying? So let's go through it that way. And we're kind of gonna just, do it step by step. We're gonna try to identify key pieces of information. And yeah, so are we ready? Yes, quick yes in the chat if we're ready. Cool, dope. All right, so Golden Ink has the following comparative income statements and balance sheets from 2021 and 2020. So see below or on the slide for statements. Now, not only do you need to compute the following ratios for 2021 and 2020, I also want us with the requirements to prepare and complete a statements of cash flows for the year ended December 31st, 2021 by using the indirect method for the operation activity section. So just before we go, here's a few additional pieces of information provided for the year 2021. No land was acquired, but a tract of land was sold for cash. New equipment was purchased for $27,000 in cash, and old equipment with a cost of $7,200 was sold at its carrying amount, so its book value. So we got a lot of information. Now, I think there's two things that I'd like to share. The first one being that typically in a question for statements of cash flows, you need at the very least to have a comparative income statement and a comparative balance sheet. Your income statement could actually just display 1 year of data, and that's fine. That just means that you maybe won't have to do complicated ratios. But what you need to understand is that you're always going to have at least 2 years or even sometimes 3 years in your comparative balance sheet for that company, because you need to be able to assess the change in your current assets and change in your current liabilities, as well as in your retained earnings and so forth. So you need at least 2 years, right? That's how we're going to be able to find the change from 2020 to 2021. So those are already the very first important things. Now, another thing that I'd like to share, in the requirements, they tell you, hey, we want you to use the indirect method for the operation activity section. This does not mean that you will only complete the operating activity section and that's it, you're done. No, this means that there are 2 ways for us to compute a statements of cash flows, and those 2 ways are the direct and indirect method. In this case, it's telling you, hey, we want you to use that indirect method for the operating activity section, and then the rest will always be the same and easy way of going about it. Essentially, there's no exact definition. The indirect method follows a sequence of steps that are different than the direct method, and both things will get you to finding the cash flows from operating activities. And we're going to be trying to look at both of them today, right? It's just a few steps that we need to take. A few different perspectives. It's like if anybody here lives in the West Island, it's like taking the 20th, l'autoroute 20, so the highway 20 or the highway 40 to go downtown. So same things, they all bring you to the same spot, but just different sequences of steps to take. So yeah, that said, what we need to do here is we understand that we're doing our statement of cash flows for a few reasons. We want to be able to understand, well, what exactly is happening to our money. What's exactly happening to our money? Because we know that our statement of earnings is not necessarily displaying the things that we think are extremely relevant. So for that reason, we're going to do exactly that. So let's get it started. Let me just get my stuff ready and we will be on the road. All right. All right, so let's get it. So the first thing that we want to be able to identify is we want to identify simply the heading, which is pretty straightforward. And that's going to be our cash flows from operating activities. You want to be able to identify every single step. Right? That's the first thing that you want to do. Now, after that, the first thing that's going to grant you some points on your exam is being able to literally just pinpoint the following, saying that the first thing that we need to look at is net income. And the reason why we want to look at net income is because we want to be able to figure out, well, what are all those different adjustments that we're going to make going to affect the actual amount of cash we have, okay? So just to summarize what I said, the statements of cash flows really wants to understand how much cash is actually flowing through the company. Now, the first place we could look at, and we did that later previously, was to say, okay, well, cash is more so equal to profits. Where do we find profits? That's in our statement of earnings. So we're going to start with that and build our way up to actually finding out how much cash we have. Does that sound okay for everybody? Does that sound cool? Is that okay? Amazing. So if we're looking at our statement of our income statement here, how much cash do we actually have? What's our net income? What is our net income according to our statements of cash flows? What is our net income? I'll be annoying and I'll ask you to write it in the chat. What is net income? What is our net earnings? Can somebody tell me what is net earnings? Okay. So Alexandra says 100,800. Leandra, why did you say 266,500,000? Why did you say that amount? If you don't mind me asking. It's a good point. So what we want to look at, the first thing that we need to do when we do a statements of cash flows question is we know we need to start with our net earnings. That's going to be the best basis point, or net income, for us to be able to do so. So what you do is you look at your income statement and you start with net income. And net income is right here. This is going to be what we're looking at, net income. And net income is equal to that amount. All right. So now that we have this, we're able to do our adjustments. All right, our adjustments to reconcile net income to cash provided by operating activities. Now, once again, the idea why we're doing these steps is because we are actually trying to figure out how much cash is the company making, how much cash is going into our pocket. So the first thing, once we've identified net income, we need to do our adjustments. We need to figure out, well, maybe there are some non-cash expenses, and maybe there's some cash that we didn't figure out through our statement of earnings through our current assets and our current liabilities. So I like to always start with our non-cash expenses. Now, within our statement of earnings, right here, within our income statement, is there a non-cash expense? Is there a non-cash expense that we do not know of or that we didn't identify yet? Is there a non-cash expense in this income statement? Yes or no? And if so, could you please write it in the chat? Is there a, okay, amazing. So Alexandra says depreciation expense. Depreciation expense is equal to 2,600. No, depreciation expense is equal to 14,300. Okay. Now, is there another non-cash expense that we did not consider? Yes or no? Is there another non-cash expense in our income statement that we did not consider? Yes or no? Is there another non-cash expense that we did not consider? Okay, so yeah, amazing, Leandra. Yes, so remember what we said before, and I really do suggest that you write this down even right now because it'll help you remember, is that there are typically 4 types of non-cash expenses that you will see on an income statement. Those 4 types of non-cash expenses are depreciation, amortization, gains, and losses. All right. Now, depreciation and amort are pretty straightforward. They're written in black and bold, right? But what's interesting here is gain or losses could be actually attributed to any type of asset or any type of liability. For example, the gain on bonds payable the loss on bonds payable, the gain on sale of land, the gain on sale of equipment, etc., on any non-current asset. And the same idea applies for losses, the losses on disposal of machinery. So these are 4 different types of non-cash expenses. Now, the reason why once again, we add our non-cash expenses to our operating activities, right, is because we're trying to figure out, well, how much money that we said we didn't have that we actually do have. For example, right here, depreciation expense is not a cash expense, so this number right here should be bigger, right? And that's why we're adding it back. So for that reason, loss on sale of land. Now, the loss on sale of land, should it be a positive number or a negative number? Yeah, exactly, Leandro. So we either gain or loss, we added. There are 4 types of non-cash expenses, right? And gain and losses are both non-cash expenses. So we both add them to our statement of earnings, even if it's a positive and or negative number, even if it's a positive for your cash or a negative for your cash. In this case, a loss on sale of land, is that giving you more cash or less cash? What I'm trying to say here is our loss on sale of land a positive number or a negative number? Is this a positive or negative number? Positive or negative? How shall we include it in our statement of cash flows? How is this affecting our cash, right? Let's say you just sold a property and you actually ended up losing $2,900 on it. Should it be a negative amount or should it be a positive amount? What about Juliana, Alexandra, and Daniela? What do you think? Should it be a positive or negative amount? I want all of y'all to answer here. It's okay for you to be wrong. It's not a problem. Interesting stuff. Okay. Exactly. The reason why here it's a positive amount is because, once again, the loss is not a real number. It's something that we just use to actually balance our journal entry. So it's just something we added to our statement of income, but it's actually not something that's going to affect our cash on hand today. For that reason, our loss on sale of land is $2,900. It's something like of a write-off, okay? So it's not a problem. Now, what I'd like to share with everybody, when we're doing our statements of cash flows, right, and we're looking at our operating activities under the indirect method, the first thing we do, right, is net income. We write that, we found that. Cool. The second thing we do is we need to essentially adjust for our non-cash expenses, right? That's exactly what we did. And we looked at our comparative income statement. However, what I also want you to do sometimes is I want you to look into your prompt. I want you to read here and see if there's anything that we may want to add to our essentially our statements of cash flows. So here we see that there's no land was acquired, but a tract of land was sold for cash. We don't see any amount, so for that, we may not need to add that to our statement of cash flows. They also tell you that new equipment was purchased for $27,000 cash. Well, that may not be useful for us. And then here it tells us old equipment with a cost of $70 to $100 was sold at its carrying amount book value. Now, what I'd like to share with everybody here, and this is something important, and this could actually get a lot of you confused for your exam, is that if something was sold, okay, at its carrying amount, so its book value, it means that no gain and or no loss was made because it was sold at exactly its value. So on our journal entry, if you guys remember from chapter 8, there would be no gain and no loss, right? So no gain would have to be credited and no loss would have to be debited because we sold it at its carrying amount. So for that reason, there's actually nothing else that we need to add to our journal entry, to our statements of cash flows, because we were able to kind of identify everything related to an adjustment, all right, to an adjustment for our operating activities. So now what's left for us? We know that we found our net income. We know that we found our depreciation expense and our loss on sale of land. So we did our net income, our non-cash expenses. Now, what is left? There are two things that we need to look at for our operating activities. What are those two things? What are the two different types of like things that we need to look at for our operating activities? We looked at them previously. We talked about it. What are the two additional things that we need to look at? The two additional categories of things that we need to look at for our operating activities. If you have any idea, is it non-current assets? Our investments in non-current assets? Should we look at that? There you go. Amazing. Yeah. So we should look at our current liabilities and our current assets. Now, our current liabilities and our current assets are actually going to be found in our comparative balance sheet, right? So really quickly, what we could do is we could actually identify all of our current assets and our current liabilities. So we have our trade receivables, we have our inventories, we have our prepaid expenses, and that's about it. There's no other current asset. And by the way, we don't look at cash because we're trying to see what's happening to cash. So always remember that. We never look at cash. So we're trying to look at everything else that's a current asset but cash. And then for our current liabilities, what's really cool here is that we have a few current liabilities. We have our trade payables, we have our salaries payable, we have our income taxes payable, and we have our deposits from customers. What's really interesting is that in exams, they actually may literally highlight this for you and say, hey, current liabilities is everything within this realm, okay? Sometimes they may not do it for your assets, so you need to be able to kind of identify it yourself, okay? So what we need to do now is we need to assess the change for every single one of these accounts, okay? Every single one of these accounts, one by one, and then we're going to add that onto our operating activities section of our statement of cash flows. So we just need to assess the change, right? So I kind of already know what it is. I'm going to ask you, please have the Excel sheet open as well, so we could try to identify what's happening to our trades receivable, to all of our current assets and our current liabilities. So for trades receivables, is it increasing and or decreasing? And if so, by how much? So what's happening to our trades receivables? Is it increasing or decreasing? Nice. So yeah. So what you would do is you would add your increase. So you do increase in trades receivables. And then because it's by 17,100, you would essentially make it a negative or a positive amount. Would it be a negative or a positive amount? An increase in trades receivable, so an increase in current assets. What do Leandra, Juliana, and Daniela think? What will this be? Will this be a positive amount or a negative amount? Okay, do we all agree? Do we think that's the case? Is it a negative amount? So yeah, that's exactly the amount. Okay, cool. Now, by definition, what happens to inventories? Is it an increase? And if so, is it a decrease? And if so, by how much? What's happening to our accounts receivables? Is it an increase or a decrease? Nice, thank you. Increase in our inventories. And last time I'm going to ask, is that a negative amount or a positive amount that we're going to add into our statement of cash flows? Negative or positive? Nice. Okay. All right, so now we have our prepaid expenses. Now our prepaid expenses is increasing or decreasing, and I need somebody other than Alexandra to answer this one. Is it an increase or a decrease for our prepaid expenses? And if so, by how much? Amazing, Daniela. So it's a decrease. Now it's by how much? By 3,500, great. So is that a positive or a negative amount? Nice. Okay, so I think we all know what's the spiel at this point. So we're gonna go a little bit faster. So trades with payables. I need Daniela to tell me by exactly how much it's increasing or decreasing. Trades payable, increasing or decreasing by exactly how much? by exactly how much? Nice, good stuff. All right, so we have an increase in trades payables by $2,200. Now, Daniela, do you think that's a positive or negative number in your statement of cash flows? Is that a positive or a negative number? Why is it okay? So it's positive, amazing. The reason why it's positive is because we know if I owe more money, it means that I'm spending less money. And for that reason, it's positive. Good stuff. Okay, now let's ask Alexandra. So what's happening to salaries payable? Is it an increase or a decrease? Is it an increase or a decrease? And if so, by how much? We're kind of going to do rounds one by one, so at least we could kind of make it interactive. Good stuff. Okay, so we have a decrease in our salaries payable. So by definition, it will be minus like that. Okay, that's the good stuff. Now let's say I think it's Leandra now. So Leandra, what's happening to our income tax payables? Increase or decrease by how much? Nice, good stuff. So increase in income tax payables. That would be equal to 500. Now, I believe it's Daniela's turn. Yes, it's Daniela's turn. So Daniela, what's happening to our deposits from customers and by how much? So is it an increase, decrease, and by how much? Deposits from customers. What's happening here? Oh, sorry, I thought you had them already. If you can, I put it in the chat and I put it in our group. It would be really cool if you could have it open as well. Such like that, I could go a little bit quicker, but if not, it's fine. So what's happening between these two? Increase or decrease? Nice. Cool. So I think we ran through all of them. All right. Okay, so now that we ran through all of our current assets, all of our current liabilities, and we've identified our net income and all the different adjustments we need to make for our non-cash expenses, we did everything we had to do for our operating activities under the indirect method. Now, what we want to do is we want to be able to just simply quantify the change in our operating activities. How much will our operating activities actually deviate? And what you'll do is you just need to write this: change in operating activities. The reason why we want to find the change in operating activities is we just want to know by how much was our net income understating or overstating our cash flows, right? So what you need to do is you just need to sum all of these together. Can somebody tell me what is the sum of all of these together? And now I'll ask Alexandra. Yeah, Alexandra, what is the sum of all of these together? What is the sum of 14,300, 2,900 minus 17,100 minus 7,400 plus 3,500? Amazing. Yes. So this is the change in operating activities. Essentially, once again, we looked at a bunch of different adjustments that we need to understand, right? To see to what extent is our net income overstated or understated, because we want to find how much cash we're making. So what we could do is we could just add all of them up together to find the net change in operating activities. And with that, we'll be able to find the cash provided by operating activities. We could just maybe. So do somebody know what will be our cash provided by operating activities? What would that number be? And in this case, I think it's Leandra. What would be our cash provided by operating activities? If you'd have to guess, how would we do that? What would that amount be? What would be our cash provided by operating activities? What would that be? Okay, it's a good part. So we found minus 600, right? But let me ask you a question. I'm gonna probe you a little bit more, Leandro. What are business operations? You could either like raise your voice or write it in the chat. What are business operations? And you could say, when do we do business operations? What is it? You could give me an example. Any answer is okay here, right? So what is a business operation? What are operating activities? Why are we looking at that, and why does that matter? If you could just write in the chat or raise your voice. And if, by the way, after I ask this question, if you guys don't want me to put y'all on the spot, let me know. It's just to make it a little bit more interactive, make it a little bit more energetic. Okay, good try. Exactly. So there are expenses being made by the company, but there are also investments being made by the company. There are things that the company is doing for them to be able to conduct their business, right? Netflix has to have employees working every day. Netflix wants to have employees working every day because they want to make money, right? That's the idea of operations. The operations of Netflix is them doing a bunch of different things to make money, okay? So we need to look at our net income as well. We need to look at net income and our change in operating activities, and we need to add them together to find the actual cash that our operating activities generates for our company, okay? So with that said, if you know that we need to add our net income to our change in operating activities, Leandra, what is our cash provided by operating activities? Amazing. Couldn't have said it better myself. Exactly. So now I want to take a step back and I kind of want to summarize what we did here. So what we did is we did the first section of our statement of cash flows. The statement of cash flows is an amazing tool to figure out how much cash is the company actually making. And the reason why we need to understand this is because we've understood that the statement of earnings may overstate or understate the actual cash that the company has made within that year. All right. So for us to figure out how we do that in our statements of cash flows, we need to look at three buckets. The first one being operating activities, the second one being investing activities, and the third one being financing activities. But a statement of cash flows holds some nuances, okay? And the biggest nuance is actually within the first section, the operating activities section. And in the operating activities sections, we could use two methods, all right? One being the direct method and one being the indirect method. In this case, we use the indirect method. Why? Because it's the most popular one that you'll see on your exam. And two, it's literally the most indirect method in the sense that it's kind of counterintuitive, but we were equipped with a bunch of different tools to do it quickly and efficiently. And those different tools could be divided into essentially, call it 4 buckets. So for you to be able to do your cash flows from operating activities by using the indirect method, you need to look at 4 specific things. The first one being net income. You need to put that first. Then the second one being is your non-cash expenses. Our non-cash expenses can be found in our income statement, and that could be anything from depreciation expense, amortization expense, a gain, or a loss. Once we found those, we can now move on to our current assets and our current liabilities. Now, what you need to remember is that if we're looking at current assets, we just need to understand that it's kind of counterproductive. So if we have an increase, we need to place a negative number in our statements of cash flows. If we have a decrease, we need to put a positive number in our statements of cash flows. However, when it comes to our current liabilities, it's pretty straightforward. If it's an increase, it's a positive number, and if it's a decrease, it's a negative number. Now, once we've seen all of those 4 things, we're actually able to add all of those adjustments together. In other words, we're able to add all of these adjustments that we've made together to find the net change in operating activities. Once we have that number, we can add it to our net income, and that's how we have our cash provided by operating activities. Now, does that make sense? Do you now understand how to do the indirect method for operating activities? Do you feel comfortable? Yes or no? Leandra, Juliana, Alexandra, Daniela. Okay, Cool. This is the only hard part when it comes to this. It gets really easy from now on. Because now all that we need to do is we need to look at our investing and financing activities. All right. We need to look at that. So let's do exactly that. So we're going to look at our cash flows from investing activities. All right. So investing activities, as we said earlier. Yeah, one last question. If it was a gain on land, would it be a negative amount or a positive amount? Well, this is actually a really good one. Typically, when you have a gain on land, actually, I don't think that we've ever put it on our statement of earnings. I mean, on our statements of cash flows, because it was already added within our net earnings, right? Because, for example, let's say this was a positive amount, right? Gain on land, then this would actually be 116,000 minus 2,600 plus 2,900, right? Instead of being minus 2,900. So this amount would be bigger, right? And by definition, our net earnings would be bigger. So what I'll say, and I've never seen a question that had that, but what I'll say, if it's a gain on land, for example, I'm not too sure that there will actually be an adjustment to be made here, right? But in this case, actually, I would say, actually, no, Alexandra, I take that back. I take that back, Alexandra. I take that back. If it's a gain on land, I would say it's a negative. Let me say that to everybody. If it's a gain, you want to make it negative. If it's a loss, it's a positive. If it's a gain, it's a negative, okay? If it's a gain, it's a negative because that gain doesn't actually exist. So it's actually overstating your net earnings. And for that reason, you need to take it off, okay? So gain on investments, gain essentially on anything that happens in your statement of earnings will have to be negative. But when we're looking at our investing activities, we need to look at it differently, okay? Because when we're looking at our investing activities, and this is a very good question by Alexandra. So let's try to make sense of this. When we're looking, my voice is cracking, but when you're looking at investing activities, we're looking at a specific category of accounts. That category of accounts is what we call non-current assets. And within non-current assets, we have building, land, equipment, essentially PPE. We have long-term investments. We have a bunch of things that are lasting more than a year, i.e. they cannot be within operating activities. So we have non-current assets. But now we need to be logical. What actually happens to our non-current assets, right? They're kind of just there. Like a home, a home remains a home for quite a while, right? A car will remain a car for quite a while. You use a car for a lot of time and you'll use your warehouse for quite some time. That's what I'm trying to say. It's not very dynamic. So what I'm trying to say here is that there's actually only two things that could happen with our non-current assets. And so by definition, there are only two things that could happen within our investing activities. So those two things could be either one, your proceeds from the sale of one of those non-current assets, or the purchase of one of those non-current assets. So within your investing activities section, there are really only two things that could happen. One, proceeds, or two, purchase, right? So proceeds will obviously be a positive number, and a purchase will obviously be a negative number because we're trying to see, well, what's happening to cash, okay? Really, really important. So now that we have that in mind, all that we have to do is we have to be able to go on our statement of financial position, in other words, your balance sheet, to be able to identify all things that have something to do with non-current assets. So what I'd like to do here right now is I would like you to tell me, well, where are our non-current assets? And just tell me what they are in the chat so I could highlight them. And we're looking at them right now. So what are our non-current assets in this case? Okay, and in this case, land and equipment. Amazing. So we have land and we have equipment. So that's really important. We have two non-current assets. Really good stuff. Now, as I said, when we're looking at this section, we're only looking at non-current assets and nothing else. We don't care about anything else, okay? However, as we did with the previous section, we always need to go back to our prompt and see if they gave us any additional notes that we did not consider yet, okay? Very, very crucial stuff. So what we're going to do is we're going to go back to our prompt and we're going to try to read if there's anything. Also, by the way, one thing that I'd like to highlight is that here it says net, okay? This is very important. Because it says net, it means that it does not give us the at cost value, okay, of our equipment. It's very important, okay? So if it didn't give us our at cost value, that means that this amount, or I'll just ask you a question, is this amount already depreciated? Yes or no? Exactly. Yeah. So this amount is already depreciated because it's net. So it's not the at cost. Essentially, how you find net is literally you take equipment at cost, so EAC, less your accumulated depreciation, which is AD. I'm just using abbreviations. And that's going to give you your equipment net. All right. Just a little pointer here. So that's something to consider when we make our different little entries here to our statements of cash flows. So if we zoom in, it says here that no land was acquired, but a tract of land was sold for cash. That's important. It's giving us context, all right? And then here it's telling us new equipment was purchased for $27,000. And this section here is telling us that old equipment with a cost of $7,200 was sold at its carrying amount. So there's quite a bit of information related to all of our PPE. Now, I'm not a professional, you know, that's the way I look at it. What I like to do is I literally like to just make sense of what's happening to our account. How do we break it down? And the best way to break it down is by using a T account, right? This is the way I like to look at it, is by making a T account such that we're able to identify exactly what's happening to our accounts with the information provided in our balance sheet, right, which is this, and the information provided by the little additional information section. So what we're going to do now is we're going to try to build this T account. But right before that, actually, I'll just ask you this. Can somebody tell me what's the change in land from year one to year two? What's the change in equipment from year 1 to year 2? Somebody tell me that, just for fun. What is the change between year 1 land and year 2 land? What's the change between year 1 equipment and year 2 equipment? Nice. Good stuff. Good stuff. Good stuff. Perfect. And what about equipment? Really quick. Nice. Good stuff. So we have that. So we understand these two things. That's really important. And what I'm trying to do is I'm trying to just give you two perspectives. One, we could do this in our head, but we could also do it the long way. And the long way will really just showcase what we just did on the side here. But just for practice, I'll do it the long way. So let's build our T account. Center for, essentially, we'll start with land just for fun. So we'll have land for, oops. So I'm just building a T account, and I recommend all of you to do this. So what we're going to do is we're going to build a T account, and we're going to identify our beginning balance and our balance at ending. So can somebody tell me what's the beginning balance for our land? And I can go back to our stuff here. So what would be our beginning balance here? What would be our beginning balance for land if we had to make a T account? What's our, and okay, so Alexandra said 23,000 for our beginning balance. What's our ending balance? Somebody else. What's our ending balance? Like anybody. What's our end balance for land as shown here? Exactly, 16,100. Literally, just a quick and easy exercise. Amazing. So really good stuff. Cool. So now we have our beginning balance and we have our ending balance. Now let's go back to our prompt. There's only so much we could learn. Okay, and by the way, can we all agree that our beginning balance is not equal to our ending balance? Yes or no? Can we all agree that these two things are not equal? Yeah, perfect. So this is really important. This means that something has happened, right? Something has happened within the year, and we need to try to figure out what exactly happened. So that's what we're going to do here. Okay. So then we're going to go into our prompt. This says here that no land was acquired, but a tract of land was sold for cash. That's super, super duper important. So we know that. And then what we also know is that we know something happened here. We know that we had a loss on the sale of land. We know we had a loss on the sale of land of $2,900. Okay. So we had a loss on the sale of land of $2,900. Now, this does not mean that this is what we're going to put here in our journal entry. However, this does mean that we need to remember that something has happened to our loss on sale of land. So a loss on sale of land is equal to $2,900. Very important stuff. And if somebody remembers, what we did here is the land that was sold, right, was equal to 6,900, right? We said that there was a decrease. If we go back here, we said there was a decrease in land from 2020 to 2021 equal to 6,900 bucks. Okay. And we know that because we sold $6,900 worth of land, right? We sold $6,900 worth of land for this to be equal to end balance of 60,100. I think we could all agree that if we sold something for 6,900 bucks, we should be receiving 6,900 bucks in cash, right? However, because we have a loss on that sale, we actually only make 6,900 bucks minus that loss. So in this case, 6,900 minus 2,900, such that what we made when we sold that land was only equal to 4,000 bucks. Okay, so I said a lot of stuff. Let me just recoup and then I'll ask you if it makes sense. So the reason why a T account is pretty cool, and you don't always need to use it, is that we know that the beginning balance is $23,000 and we know that the end balance is 16,100. So with that, we're able to figure out how much land did we actually sell, right? We sold, well, $6,900 of that. However, when we're going to make that journal entry, right, there's this idea of loss on sale of land. And that loss on sale of land was equal to 2,900 bucks. So the actual cash that we made from that transaction is equal to this minus this, which is 4,000. Does that make sense to everybody? This is what we actually made from the transaction. Yes or no? Yeah, any questions? Does that make sense? Oh, no. No questions? Okay, cool. So now that we have this key information, right? With that, we're able to add that to our statement of cash flows. We're able to add it in our statements of cash flows simply as proceeds from sale of land. And because proceeds, and because we know that it's 4,000, this number has to be positive. All right. So that's the first step. Now, let's go back to our equipment. Equipment, as we can see here, I think we could all agree that equipment has increased by, as we said, 10,700. That's something that we know. So by definition, this probably means that we purchased equipment. Does that make sense? If equipment increased, that probably means we purchased equipment. Yes or no? Right? This means that we purchased equipment. If our equipment increased by 10,700, it means that we purchased equipment. Okay? But if we go back into our prompt tells us, yes, for sure, you did purchase new equipment for the value of $27,000. However, it's also telling us that equipment was also sold for $7,200. Okay? That's very important to understand. So we need to understand that we for sure bought equipment, but we also know we sold equipment. The last thing that we need to remember here is that we also know that our equipment is actually net, right? So our equipment is net of depreciation. So when we make our T account, we need to remember to add depreciation. All right. So with all those different pieces of information, are we okay? Do we feel comfortable? Are we ready to do our T account? We'll take that as a yes. Okay. So let's build our T account. Now, remember these two numbers. I'm going to ask you all to tell me what's the beginning and end balance. All right. Okay. Okay, so we're looking at equipment. So what is the beginning balance for equipment? If somebody could tell me. What is the beginning balance? Nice. So thank you. So that's our beginning balance. What's our end balance? It's that amount. Nice. Okay, so that is good stuff. Now, the only thing that we're missing, we're missing a few things actually, is can we all agree that we purchased equipment this year? Yes or no? Hell yeah. Okay, and for how much? How much equipment did we purchase? If you remember. Very close. Yeah, it was for $27,000. So it was for $27,000. So I think we could all understand. So what's funny here is that we know we purchased equipment for $27,000, but when we look at the change in equipment, we notice that it's only for $10,700. So now there's a disparity, and we need to understand what that disparity is, okay? And before I proceed, I'd also like to tell everybody that when you have a non-current asset, I definitely do recommend segmenting the entries in your cash flows for investing activities into two parts. Because we know equipment is sold and purchased, I recommend doing two separate entries in your statement of cash flow. So we're going to have purchase of new equipment and then proceeds from sale of equipment. Like that, it'll be easier for us. We're going to try to bucket these things into two separate buckets, okay? But yeah, as I said, we know we purchased something for $27,000, yet we only have a change of $10,700. And we also know, by the way, we also know that we only sold $7,200 worth. So there are a few things that are kind of all over the place. That's interesting. Okay. However, what we also know is that we know that we have depreciation expense for this equipment. It's super important for us to remember that. So we have depreciation expense on this equipment. Can somebody tell me what is the depreciation expense on this equipment? What is the depreciation expense on this equipment? What is the depreciation expense? What is depreciation expense? Does everybody agree with Alexandra, or should it be a different amount? Do we agree with Alexandra real quick? Yes or no? Yes, good stuff. Exactly. Now, quick fact for y'all. The reason why depreciation expense, we're taking it as is from our statement of earnings is because depreciation expense could only exist for non-current assets, right? So chapter 8, property, plant, and equipment. Now in this question, there are only two types of non-current assets. There is our equipment and there's also land. I don't know if y'all remember from chapter 8, but land could actually never be depreciated. And for that reason, depreciation could only be attributed to equipment, right? And so that's why we're taking 14,300 as our entire depreciation expense for our equipment, because we're trying to figure out what's happening to that account. Okay, so now let me ask y'all, does this balance? So is 94,200 plus 27,000 minus 14,300 equal to 104,900? Is that the case? Yes or no? Okay. So somebody other than Alexandra, could you tell me what are we missing for this to balance? What's the amount that we're missing to balance this equation? What is the amount that we're missing to balance this equation? What is the specific amount that we're missing, right? This does not balance. I want you to tell me by how much is this not balancing? I'll help you all. So we can do this plus this minus this. It gives us this amount. So we're off by how much? How much are we off by? Yeah, amazing. Exactly. So we're off by $2,000. Okay. And that amount that we're off by is going to be our proceeds from the sale. That amount will be the proceeds from the sale. And from that, we'll be able to balance our equation. The proceeds from the sale, 2,000, right? And that's exactly what we're going to be able to add to our journal entry, 2,000. Now, let me ask you all a different question. What should be our journal entry? I mean, not our journal entry, but what should we add here for the purchase of new equipment, right? What should we put here for the purchase of new equipment? What should we put here for the purchase of new equipment? Nice, Leandra. You killed it. Yes, minus 27,000. It's literally as easy as that, right? And I'll put here proceeds from sale of equipment and this one as the only 2 points that you may want to look into a little bit more. But purchase of new equipment is as easy as that. It's as simple as that, okay? So if I ask y'all, what is the cash provided by investing activities? How much is that equal to? The cash provided by investing activities. What would that amount be equal to? Is it a positive or negative number though? Daniela. Nice. Very good job. Hell yeah. Okay, cool. So what I'd like to do is quickly just summarize investing activities, ask you if that's cool. Then we're going to move into the final and easiest part, which is financing activities. Okay, so what I'd like to say here is that first and foremost, investing activities, we're only looking at chapter 8 type stuff, i.e. we're only looking at non-current assets. What are non-current assets? We're looking at PPE, we're looking at machinery, we're looking at anything that is non-current assets. It's very clear, long-term assets, it's in your statement of financial position. Now, the reason why we're looking at non-current assets is because these are investments that the company is making in the long term. It's very important. So that's why we're only looking at chapter 8 stuff. So when we're looking at this section, investing activities, there's only 2 types of entries, either a proceed or a purchase. I mean, yeah, proceed or a purchase, i.e. a sale or a purchase, right? A purchase will always be negative and a sale may be positive or negative, depending on the case, okay? That's super duper important. Now, a purchase is always super easy to put in. These are free points because it's literally the amount given in the note with a positive, with a negative sign. Whereas a proceed from the sale of an asset, that one could be a little bit trickier, right? And you really need to understand one thing. Land, the proceeds will always be vis-a-vis the gain and or the loss provided in the statement of earnings, if there is one. However, when it comes to equipment and other types of non-current assets, there may be depreciation attached to it. And if the case gives you a case in which there are depreciation, you need to make sure to add it to your journal, to your T account. In other words, using a T account for cash flows from investing activities will really give you a better sense of what's actually happening to your non-current assets, i.e. the long-term investments of the company. Once you have all of these different inputs, once you have all of these different answers, you're going to be able to just sum them up together to find your cash provided by investing activities. That said, now, is that okay with everybody? Do you have any questions for this? Any questions, yes or no? Easy, cool, comfortable? Cool. All right, so financing activities, once again, it's literally money raised by the company by debt and or equity. As much as you could raise money by debt and or equity, sometimes you may need to repay your creditors, and sometimes you may need to share your money with your shareholders, right? So when we're looking at financing activities, you could look at literally the money being raised, so the cash the company is making, which is a positive amount, or you could look at the money the company is spending, either towards its creditors in principal repayment or towards its actual shareholders through a dividend payment. So it's really between those two scenarios. So what we're going to do now is it's rare that you really need to look at the notes for this, but it could be useful. In this case, we just won't need to. But what we need to look at here now is we need to look at our long-term liabilities, because that's a debt of the company, and we need to look at the shareholders' equity to see what's happening to our common shares, see what's happening to our retained earnings, etc. So as you can see here, we're going to have notes payable, we're going to have common shares, we're going to have retained earnings. Okay. So in this case, we'll use a different color. In this case, the company had $65,000 in notes payable and now has $57,000 in notes payable. So obviously, their debt in the long term decreased. How much did it decrease by? How much did the notes payable due in 2024 decrease by for the company? 8,000. Cool. 8K. So because we know that, we could literally just write this down into our statement of cash flows as repayment of principal on notes payable for the amount of positive 8,000 or negative 8,000, Alexandra? Positive or negative 8,000? Because they had to pay in cash, right? So now let's look at common shares. Obviously, the company's common shares has increased by 6,000, right? So what does this mean? If the company's common shares has increased by 6K, it means the company had to issue shares. And in this case, they issued shares and they received $6,000 for that. So let me ask Leandra, in this case, how much did the company earn through its issuance of common shares, and should that be a positive or negative number in the statement of cash flows? Okay, positive or negative? Yes, exactly. Well, because if Netflix issues shares on the market, right, they're going to get money from shareholders, people that are buying their stock. And because they're buying their stock, well, Netflix is going to receive cash. So when you issue shares, you're always getting a positive number. It's always positive. For that reason, this is 6,000, always. Okay. Now, let's look into retained earnings. Retained earnings, you just need a little bit more heavy lifting, but it's really straightforward. So when we're looking at retained earnings, what we can notice here is that the company's retained earnings seems to have increased, right? It seems to have increased. However, did it increase by the right amount? So for you to see how retained earnings actually works and to see what's the relationship here, all that you have to do is you need to take your retained earnings here, right, from the beginning balance, so the previous year. Then you need to add your net earnings from the current year. So what you're going to do is you're going to do 11,900 plus 101,800, and then you're going to subtract your retained earnings of the current year to figure out how much dividends right? How much dividend payments were made by the company. The reason why we're doing this is because, well, naturally, the retained earnings, right, of like the ending balance, so we could call it ending balance retained earnings, should be equal to retained earnings of the previous year, so beginning balance, plus net income, right? Because in an ideal world, you would keep your net income, right? And you would add it to your retained earnings. Retained earnings is just all the cash the company has made in the past. And the net earnings you made this year, right? The profit, technically you should just add it back to your bag of cash, right? If I had $100 yesterday and today I made $1,000, well, I'm just going to take my $1,000 and add it to the cash I had before, and now I have 1,100, right? But in this case, we see that, well, hey, I don't have 1,100. So clearly I paid somebody something. Maybe I had to pay my boss or something of the sort. And that's why we do this little manipulation. So if I had to ask you, and it would be somebody other than Alexandra, what would be our dividend payments? Can somebody tell me what that amount would be with all the information provided? We have 11,900 here, 74,600 here, and then we know our net earnings from the previous, well, from this year is 101,800. How would you get your dividend payments? How would you do that? I'll add it here. So somebody could give me the amount. Can somebody tell me what that amount would be? Killed it. Amazing. Does everybody understand how Leandra got 39,100? Does everybody get that? No. Okay, amazing. So if we look at our formula here, it's as I said, right? Let me go here. Perfect. So the company has retained earnings, right? You could think about this as a bag of cash that the company has, right? This is a very disgusting looking bag, but it's a bag of cash, right? I could even try to put a dollar sign, okay? And in an ideal world, the company would add back the earnings it made this year into its bag of cash, right? You would want to add the money you made to that bag of cash. And that's exactly what we're doing. In this case, we had 11,900 and we made something like 100 grand. I just don't remember. So you would add these two numbers together because you want to see how much money does the company have right now. However, what we've noticed is that this amount, right? Daniela, can you tell me what this amount would be? 11,900 plus 100,800. Can you tell me what that number would be? I believe it'll be like 112,700, something like that. Could be wrong. What would that amount be, Daniela? This amount right here, 101,800 plus. What would that amount be? If anybody else wants to share, it's okay too. I would bet that it's something like this. Yeah, exactly. Good, amazing. So now we have this amount. So Daniela, could you agree that technically this should be how much they have in retained earnings, right? This should be how much they have, yes or no? Yeah, 100%, right? They're just adding to their big bag of money, to their lucky charms. But as you could see, it's clearly not equal to 74,000, right? It's clearly not equal to 74,600. So Daniela, do you agree that something must have happened? Like something must have happened, yeah? Okay, cool. Well, typically in the real world and for this like class, that's something that happens must be what we call dividend payments. Payments that the company made So if we go here in this little bag, they took this bag and they said, you know what? I want to be nice. I'm going to go repay every little people in the stock market that has invested in the company. Okay? So the company is taking from this amount and it's going to repay these people. So they're happy. Okay? But that means that by definition, they're going to have less money in their bag of Lucky Charms. They're going to have less money in their retained earnings. Does that make sense, Daniela? Yeah, perfect. So because they're going to have less money in their bag of Lucky Charms, what we're going to do is, well, we were going to figure out, well, what's the exact amount that they paid in dividend payments? So all that you have to do is you need to take that sum, right, of retained earnings plus net earnings. Then you're going to subtract the retained earnings of the last year. So this one's 74,600. And that's going to give you your dividend payments. Perfect. Yeah. So this is like the biggest, a lot of students get this wrong on the exam. So it's really cool that now you know exactly what to do. So epic stuff, that's solid. So now we have all this. So if I had to ask, what is the cash provided by financing activities? What is the cash provided by financing activities? Can somebody tell me? Nice, amazing. So now that we have all that, we could see the increase in cash and cash equivalents. In other words, you just want to figure out, well, what was the actual increase of cash, as we said, because the goal for why we're doing this is because we're trying to figure out, well, what cash did we not consider in our statement of earnings? So all that you have to do, it's super easy. You just need to add your cash provided by operating activities, with your cash provided by investing activities, with your cash provided by financing activities. And that's going to give you the amount 39,100. Okay? So that said, what we need to figure out now is we could do something really cool. We could sense check whether we have found the right answer. And in order for you to sense check this, right? Because, okay, can everybody agree that this is the actual change in cash? Yes or no? Yeah, 100%. This is the actual change. This is actually how much cash we made this year, right? This is the real amount of cash we made. So what you could do here is you could write here cash and cash equivalents. It doesn't have to be like that, but you can. On December 31st, 2019, so i.e. 2020. I think that's a little typo, my bad. Let's write this 2020 would be equal to 16,000. I think, can we all agree that the cash December 31st, 2020 is equal to this? Yes or no? Really quick. Cool. Okay. So technically, does everybody other than Alexandra also understand that? Like, yeah, that this is 16,600? Okay, cool. So technically, this plus this should give us our cash for 2021. I think that makes sense. Because somebody try to tell me what that gives us, 39,100 plus 16,600. What amount does that give us? Exactly. And is that the same number as we have here for 2021? Exactly. So in order for you to figure out whether you did the right things, you need to make sure that the sum of these two is equal to this, right? Because we want to figure out how much cash did the company actually make this year? How much cash does the company actually produce? Because net earnings doesn't necessarily replicate the amount of cash the company has ready, right? The number of cash the company could actually move and do something with. Because all of these different current liabilities, current assets, investing activities, financing activities are representative of what the company needs to do on a year-to-year basis. So we want to figure out, well, scratch all that. How much cash are they making after all those different decisions? Okay. So let me just zoom out. Are we comfortable with this? Do you have any overall questions before we take a little break and we try to do another one like this? Are we okay? Does that make sense? Yeah? Okay. Any questions? because we're gonna do another one just like this, so don't even worry about it. All right, so if there's no questions, we're gonna take a 5-minute break. All right, we're gonna take a 5-minute break. We're gonna come back right here, and we're gonna go up until about 7:50-ish. All right, so see y'all in 5 minutes. So let's re-meet at 7:13. Call it 7:13, yeah. Okay, are we excited or what? Last one. Listen, we're doing good work. I think we're doing some good work. So I think we're going in the right direction. So this one, we're gonna go a little bit more rapid fire. I want to get this done by 7:50, 7:55. I need to leave like 5 minutes earlier today. But before we proceed into this one, same thing as last time. Chapter 10 had a course pack. This one is a big chapter, so I'll also make like a Word document with like 5-6 pages. And then every single one of these problems will also have detailed, like clean solutions to them, okay? And then next session, I believe it's on Thursday. We're gonna have our first like crash course, like our first like thing all together, where we're gonna be doing final like questions, like with multiple choice, all that good stuff. I sent you the decision. And then Saturday and Sunday, we're also gonna have sessions, all right? So that said, it would be amazing if you would also have this open on the side, so I don't have to show you like every single one of the lines. You could just tell me like, hey, it's 2 to 5 p.m. 2 to 5 p.m. and I would like to do it in person. I'm gonna write a thing in the group chat tomorrow, like a video. Y'all could tell me if that works, if that doesn't work. So that said, let's go into this one. Ideally, everybody here has their Excel open, like another one, not just my screen recording, so that when I ask you, hey, is this increase or decrease, you just tell me what it is immediately, and we could kind of go smooth. But we got 45 minutes, so we should be fine. Anywho, Hermes and Hades, Hermes or whatever, Hermes and Hades has the following comparative income statement and balance sheet from 2020 and 2021. I want you to prepare a statement of cash flows using the indirect method for the fiscal year 2021. Here are some additional pieces of information provided for that year. 1, new equipment was purchased by using the cash proceeds from issuing shares. Slightly used equipment was sold for cash because it was no longer needed. Certain long-term investments were sold for cash under book value. New bonds were issued for cash under face value. Additional land was purchased for cash. There was no disposals of land. A large cash dividend was declared and paid. So there's a lot of stock, and we're going to try to go through it. But the first step, as per usual, is to make our statements of cash flows. And we're going to start with our cash flows from operating activities. So what is the first thing that we add? What is the first thing that we should put here? Somebody tell me in the chat. Net income. Hell yeah. Net income, net earnings. I like to call it net income. So can somebody tell me what is net income? For what amount? It's on our left. It's on the screen. 51,000. Hell yeah. Okay. So now we're going to make our adjustments to reconcile net income to cash provided by operating activities. Now, by the way, you like totally do not have to write it like this. It's just, you know, I like it because it's best practice, but you do not necessarily have to write like adjustments to reconcile net income to cash provided by operating activities. You could just write like adjustments to reconcile net income or like adjustments to net income. Like they all mean the same thing. Okay, so what we could see here is that we have our little income statement. It's not huge, but I'd like to ask you, what is the first non-cash expense that we're going to add? Like we see it in bold. Juliana, you didn't like answer a question yet. So Juliana, what do you think it is? Do you think Daniela's correct? It's okay. Do you think Daniela is correct for depreciation expense? And if not, what do you think the answer would be? And in like 20 seconds or so, I'll just ask everybody to give it a shot. She's right. Okay, so depreciation expense. Depreciation expense here, where is it? Where is depreciation expense? I'll even highlight it. Where is it? Is it this? I think so. And what is the amount attached to it? 17,000. Okay, so depreciation expense is one of the first non-cash expenses that we need to reconcile, right? After we did net income, and it's for 17,000. 51,000 was our net income. So depreciation expense is of 17,000. Whoops. Okay, so this is really cool. Alexandra, you had that question. What happens if it's a gain on disposal of equipment? So what would be the answer here, Alexandra? This is a non-cash expense. And what should I put here? Positive or negative? Great job. Great job. You killed it. So this is minus 3,000. Leandra, Juliana, and Daniela, do we understand why this is a negative and not a positive? Okay. Okay, I think we're good. I think we should be fine. So now we have that. I think it's pretty evident that we now did the first two steps, net income and non-cash expenses. You could literally go one by one and be like, okay, I think we went through all of them. Now, let's go to our current assets and current liabilities. So if we go here, this is a current asset. This is a current asset. Now, I'd like to ask you, is this a current asset? Is this one a current asset right here? Long term. Exactly. The answer is no. Amazing. Sorry about that. Okay, so that is not the case. For that reason, we do not consider it. Now, what about our current liabilities? So we have this current liability, we have this current liability, and we have this as a current liability. Is bonds payable a current liability? Yes or no? Because we're going so fast, I need to go a little bit slower at times. So is bonds payable a current liability? Yes or no? We spent a lot of time on bonds payable together. Okay, well, yeah, the answer is no, 100%. Okay, so now I'm assuming that you all have the Excel and questions open in front of you, like aside from the recording. So I'm going to ask y'all, what's happening to trades receivable? Quick, what is happening? Is it an increase or a decrease? Is it increase or decrease the trade receivables? Okay, so I need a tiebreaker. There you go. And yes, it's by 24,200. Okay, amazing. Okay, then what about our merchandise inventory? Increase or decrease? Decrease or increase in merchandise inventory? Amazing. And by how much? Par combien? By how much? Donna desu ka? If that's Japanese, I think so. But yeah, 43,000. Now, what I'll do is when I say by how much, just give me the amount that I need to put in my statements of cash flows. So what about trade receivables? Is it a increase or decrease? I'm gonna ask Juliana. Increase or decrease, trade payables, what is going on? Increase, decrease, and in like a minute, anybody has the right. So what I'll do now is I'll also like probe every single one of y'all. And after a minute, if there's no answer, everybody has the right to answer. So now it's been like 30 seconds or so, but trades payable, increase or decrease, and by how much? So you think trades payable increased or decreased? From this year to another year, did it increase or decrease? Okay, so it decreased by how much? What should I put here? So decrease in trades payable by how much? Like 32.8. Okay, it's a positive or negative number? Positive or negative number? Okay, so it's important. This is actually a negative number. The reason why it's a negative number, and we kind of alluded to this before, is that if we are actually decreasing our liabilities, the debt we owe, it means that we have to pay that debt. For that reason, for us to pay that debt, we need to pay it in cash. We're assuming they're paying it in cash. So for that reason, it's a decrease in trades payable. So now I'm going to ask Leandra. So Leandra, what about accrued payables? Is it a decrease or increase? And if so, by how much? And you got like a minute, and then anybody else has the right to give it a shot. So what's going on here to our accrued payables? Increase or decrease? Increase or decrease? It's a decrease. Okay, by how much? By how much? And Juliana, I'll answer in 10 seconds as soon as I have the amount. So decrease in accrued payables by how much, Leandro? Negative or positive? Negative or positive, the 8,000. Nice. Okay, yeah. Juliana, what's up?
I don't understand why the trades payable is negative. Isn't like it's so like that means the rule of like let's say it's increased, then it like that means it's negative. Like it's not always like right, that rule basically for operating activities.
Okay, so that's a good question.
In my head, whenever I see operating activities, I always do like the opposite. Like I don't think about it twice. I just like do the opposite. Do you know what I mean?
So what we'll do here is we'll add this. So check this out. We have a little table. So we're gonna have inc and we're gonna have dec. So inc for increase and dec for decrease. So what we're gonna write here is we're gonna write whether it's a positive number or a negative number. So if current assets is a positive, like if there's an increase in current assets, that means that by definition, we have to pay for current assets, right? So we do the opposite. We do, if it's an increase, it's a negative. By definition, if current assets are increasing, therefore it's negative. Then if current assets are decreasing, then it should be positive, okay? So already there we have our rule, and that's probably what you've applied. Now, when we look at current liabilities, well, what's interesting here is that if our current liabilities are increasing, then it means that we're actually not paying what we're supposed to pay. So we actually have more cash on hand. And for that reason, if our current liabilities are increasing, then it's a positive number, right? That's a positive thing that we're going to add. And then if our current liabilities are decreasing, it means that we paid the debts we owe. And for that reason, we need to put a negative number to our statement of cash flows. So this is like the little table you could use, right? And essentially what you were saying was like a general rule for all the operating activities that still holds, but there are sub rules for current assets and sub rules for current liabilities. So you just want to do the opposite for each type, right? So current assets, you do the opposite, current liabilities, you do the opposite of what's rational. Does that answer your question? I think so. Yes, amazing. Okay, so I asked Daniela, I asked Juliana and I asked Leandro. Okay, so Daniela, now I'm gonna ask you this. What's happening to our income tax payable? What's happening to our income tax payable? What's going on there? Increase, decrease, and what am I gonna put in my statements of cash flows? Nice, okay. All done? Yes, exactly. So for that reason, we're gonna have 7,000. Okay, cool. Now I'm gonna ask Alexandra, what is happening in our operating activities? What is the total change? Can you tell me that? What is the total change here? If you remember, we do the sum of every single thing we've added. What is the total change? Now, maybe there was an error because you want to add all of these together. So probably there was like one, like probably this one you put as a negative, I think. It's possible. Yeah, exactly. Makes sense. Totally. 100%. So yeah, that's a totally fair error. Even on the exam, they won't take you a lot of marks because that's like, they know that you had it there. So no worries. That's really good stuff. So with this, we are able to find cash provided by operating activities. Okay, so I'm gonna ask, I believe now it's the turn of, I have like the memory of a turtle. Now I believe it's the turn. I'm gonna go with I'll go with Leandra. Leandra, what is our cash provided by operating activities? What is the cash provided by operating activities? It's a very simple little thing you got to do. You got to add two things together. Nice. Good stuff. Okay, now we're on a roll. I'm loving this stuff. Loving this stuff. It's good stuff. Okay, so cash flows from investing activities. Okay, so I'm gonna ask you a question just to see if you remember. So we did Leandra now. So Juliana, what type of accounts do we look at in cash flows from investing activities? I spent a lot of time talking about it. What type of account? What type of account are we looking at here? Are we looking at liabilities? Are we looking at current assets? Are we looking at non-current assets? Are we looking at shareholders' equity? What are we looking at? What's like the golden rule here? What are we looking at? So for investing activities, we're looking at our non-current assets. Liabilities and shareholders' equity, we're going to look at that in our financing activities. So investing activities are literally investments that the company will make in long-term assets to help the company make money in the future. Now, as I said before, we're looking at property, plant, equipment, land, long-term investments, etc. So what we're going to do now, before we make that next step, I'll kind of identify the things we need to look at. And I'll ask for your help, actually. So here in our assets section, what should we highlight? What are the different investing activities? What are the different non-current assets that are important? Anybody could answer here. Just tell me what I should highlight. So there's land and equipment, right? And by definition, this as well. Is there something that we're missing? Is there one thing that we're missing? Long-term investment. There you go. Very, very important, okay? So now what we did is we went back, like honestly, really, when we're doing this, we really have two steps, right? Depending on which section of our statements of cash flows we're in. What you want to do is you always want to look back to your statements provided by the question. In this case, you want to look back at your income statement, or you want to look back at your statement of financial position. That's what they gave you. Once you're done with that, then you want to go back to the prompt and you want to identify if there's anything related to what was provided in those statements. Okay. So now that we did that, I just want to go back to our statement of financial of income statement. I want to look at our income statement. Don't forget that we may need the gain on disposal of equipment because we know that's a long-term asset. So we may want to remember that, okay? Then once we've done that, once we surveyed both statements, we're able to go to our question, right? And we're able to highlight stuff related to this scenario. So let's look into that. Okay. So what I would like to say here is that we have new equipment was purchased by using the cash proceeds from issuing shares. Okay, it's important. Then slightly used equipment was sold for cash because it was no longer needed. So we know we sold equipment. Okay, and then certain long-term investments were sold for cash at their book value. All right, and we see here that additional land was purchased for cash. That's important. So that's pretty important. So we have 4 different entries related to this. And we also see here that we have 3 different types of assets that we need to consider. So what I'd like to do is I want to make it simple for us. We're going to do a little check here. So we're going to have our long-term investments. We're going to have our land. Then we're going to have our equipment. Then what we're going to do is, because we know when we're in our investing activities section, we know we could have a proceeds sale, and we know we could have a purchase. So what we're going to do here is we're just going to write yes or no if it's a purchase and or a sale. So for our long-term investments, did we sell anything? Yes or no? Yes. Cool. Did we buy anything for our long-term investments? Yes or no? Did we buy any additional long-term investments? So let me help you out with this. You could cross-reference this by looking at our statement of financial position. It's going smaller. So by definition, this indicates that we sold something. Makes sense. And if we go here, they also tell us, hey, we sold something. So does it seem like we actually purchased anything? Just once again, let me ask you this. Does it seem like you purchased anything? Daniela, Juliana, what do you think? So you think we bought more long-term investments, Daniela? No, exactly, because it got smaller, right? So I'll also add here the change. So change. This will be important. So we're going to put minus 15,000, right? So here we have minus 15,000. So we know we have our change. Perfect. So this should make sense. Okay, cool. So no purchase. Amazing stuff. So now let's go see land. Let's go try to make sense of land. So let's go make sense of land. So what's happening to land? Land, okay, as we can see here, it got bigger, right? I think we could all agree it got bigger. It got bigger by $40,000. That's important. All right. Now, what we need to see here, so if it got bigger, it probably indicates that something is going on and that we probably bought something. Now, all that we want to do is we want to verify if there was any sales. Okay. So we're going to go all the way into our prompt and we're going to see. So when we're looking at this idea of land, so additional land was purchased. Amazing. So I don't see anything about about selling land. So by definition, do you guys think we sold land? Yes or no? This is a bigger amount. So it indicates that we bought something. And the prompt says nothing about selling. So did we sell something? Yes or no? So Leandra, Juliana, Daniela, what do y'all think? Did we sell land? Leandra says no. What about you, Daniela? Did we sell land? Juliana says no. Amazing. Exactly. Okay. So just to make sure, this amount is getting bigger by 40,000. And the additional notes said nothing about selling. So by definition, it's obvious that we only purchased. Okay. So no sale, yes purchase. All right. Now we're going to go see for our equipment. As you can see here, equipment actually got smaller. So what does this tell us? Does this tell us that we bought something, or does it tell us that we sold something? What does this indicate? A purchase or a sale? Just off the bat, just from that key insights, does this indicate a purchase or a sale? If it got smaller by $10,000. Alexandra says sale. What did the others think? Leandra, what do you think? Juliana, what do you think? Daniela, what do you think? Sale, what does this indicate? Exactly, it indicates a sale. Amazing. So for sure it's a sell. Now, how we do this, just to make it super clear, the first thing you want to do is you want to look at the change. And if the change is negative, it probably means we sold something. But then you just want to make sure that the keynote, the additional information, doesn't say otherwise, because then we may need to dig deeper. In this case, we for sure know we sold something. Now we need to look into our notes to make sure that maybe there isn't something else that has happened or something additional. So in this case, we're telling you that, hey, equipment was purchased, amazing, but also some equipment was sold. So we need to look at both of them, okay? So by definition, here we have two yeses. We have yes to the proceeds and yes to the purchase. So some important stuff, amazing stuff. So now, I don't know if y'all remembered, but the cool stuff here is that when it's a sale, we need to get a little bit scared. It's not scared, but we need to be more, zoned in. But when it's a purchase, it's actually the easiest thing out there. It's so simple to do a purchase. It actually takes 2 seconds because it's simply, you just put the amount of the purchase. It's really as easy as that. So what I suggest is that we start with our, so let me ask you this. How many entries should we have in our statements of cash flows? How many yeses do we have? We have 1, 2, 3, 4, 5, 6. We have 4. So by definition, we should have 4 entries to our statements of cash flows. Okay, really important. And also, what I'd like you to remember is how I do it on my exam. I like to start with the easy stuff. So you start with the purchases because it's very simple to put in. Then we could look into the sales. So we're going to start with the purchases. We're going to start with land and equipment. So if we go here, we're going to write this. We're going to write acquisition of land. Can somebody tell me it's for how much? For how much did we acquire land, and is it a positive or a negative number? How much did we acquire land, and is it a positive or a negative number? How much did we acquire land for? And is it a positive or a negative number? Important stuff. Okay. What about Leandra, Juliana, and Daniela? What do y'all think? Is Alexandra right? That's a good question. Leandra agrees. What about Daniela and Juliana? She is right. Juliana, do you think Alexandra is correct? Does that make sense that we purchased something for $40,000? Yes. Those are free marks. You know what I'm saying? Those are free marks. All right, good stuff. Now, if we go back to our scenario, so we got this out of the way. Cool beans, very cool. So we can put it in green. What about equipment? If we go to equipment, okay, we know that our equipment got increased by a specific amount. That's interesting. But here, in the prompt, they're telling us that new equipment was purchased by using the cash proceeds from issuing shares. So where should we look at for issuing shares? We know we issued shares, and whatever cash we got from that, we bought equipment. So what should we do? Can somebody tell me? What should we do? What should I do now that we read this? We know we bought equipment, and we know how we bought equipment, and we know for how much. So how do we quantify this? How do we tie it all together? Can somebody tell me? What do we do now? Where do I look? Like, help me find the answer, if anything. What do we do? Qu'allons-nous faire? Je ne sais pas quoi faire. Alexandra, what do you think we should do here? Okay, I like that. What do y'all think? Do you think that's a good idea to look at common shares and calculate the difference? Alexandra, can you tell us why we should do that? Just for fun? I'm being annoying, but you know, we're doing good on time. Why should we do that? Why should I look at the difference in common shares right here? Why should I do this? What does this tell us? The difference.
Because like the increase, that's like the cash that they got to buy the equipment.
There you go. Exactly. You killed it. Amazing job. So we're looking at the difference between common shares on year 1 versus year 2, because for sure that means they made more cash. I think we could all agree to that. That means they made $31,000 more. Now, they didn't just use that cash and do whatever. They took that cash to buy equipment. And by definition, if they took that cash in its entirety to buy equipment, it means that they spent 31K on equipment. All right, that's what that means. So here we could say purchase of new equipment. And Juliana, what would be the amount that we would write here? What would be the amount that we write here? With everything that we just said, what do I put here? Well, and one thing, we looked at an amount, we looked at a specific number for a reason. So maybe we use a specific number. We looked at the difference of common shares from 2020 to 2021. What amount did that give us, Juliana? 2020 and 2021. Common shares, what was the difference in the two? What was the difference between this year and this year? $31K. Okay. Is $31K cash that the company got? Yes or no? Quick. Yes or no? The company issued shares, so they received $31,000 in cash. Yes or no? Yeah. And they said that they used the cash here to buy new equipment. So by definition, Juliana, what do I put right here? They used that cash in its entirety to buy that equipment. So by definition, Leandra or Juliana, what am I going to put here? What am I going to put right here? What is the amount? Okay, negative or positive? Juliana, negative or positive? What are we doing? Leandra, what are we doing? Negative or positive? Negative, exactly. Good stuff, amazing. Okay, so now we went through the hard stuff. The easy stuff, sorry. The easy stuff, free, absolutely free points. Now, we want to look at maybe long-term investments. Let's try to make sense of that. What's happening to our long-term investments? So by definition, I think we could all agree that our long-term investments decreased by $15,000. And if we read our prompt, they're telling us, hey, we sold our long-term investments at book value. That's it. So by definition, if I ask anybody in the chat here, the proceeds from sale of long-term investments should be equal to of how much? Exactly. You killed it. Amazing, Leandra. Good stuff. Okay. So now we already got 3 out of 4 in a second. It was so easy. We killed it. Now we need to look at equipment. Equipment is where it gets a little bit more interesting. And that's where we need to make sense of things. So what I'd like to do is I'd like to try to make sense of essentially what is going on here. And I think a journal entry would be best, because that's how you really, break it down. So we're going to just merge bottom. We're going to look at equipment. Look at our beginning balance. And I guess we're going to look at it net. Yeah, that would make sense. Okay, so let me ask y'all a question. And we know we have depreciation expense. Ask y'all a few questions. So what is our beginning balance for equipment? What is our beginning balance for equipment? We have 92K, right? Then we have 82K. I think we could all make sense of that. I think that's pretty fair. Cool beans. All right, so we have that. Yeah, I think that should make sense. Oops. Okay, so we have those two figures. We know our beginning balance is equal to 92,000. We know our ending balance is equal to 82,000. That's good stuff, good stuff. So we could do this, put it as a number, maybe put it like this, and then we could... Cool beans. Okay, so we have that. Now depreciation expense, can somebody tell me what's the depreciation expense for both years? If you know. Can somebody tell me what's the depreciation expense for like 2021 and 2020 type of thing? Nice. So we should be on the right track, I think. So we have that, and it was 15,000. Okay. So we should be good. Now, what's another thing that we know here? We know that we also bought new equipment. How much was that new equipment? How much did it cost us? 31,000. Good stuff. Okay. So we know all that. We know that we bought new equipment. And now let me ask you this. I'm curious to see if this is going to work out as well as I think it should. So does this balance? Does 92 plus 31 minus 15 equal 82,000? Yes or no? Let me see if it's the case. Should make sense. No, right? I don't think so. So let's try to see what happens. This plus this minus this should give us 77,000. I think we need to remove perhaps this one. That's 10K. It gives us 77,000. So it's not balancing. All right. So this part's a little bit more interesting, and I'm trying to find a way to make sense of it in the next 4 minutes. So the way, let me see if I'm missing something. I haven't done this one in a bit. Let me see. Okay, so we know it doesn't balance. So that's the first part. So we know we bought new equipment for sure. And I think, for example, that we could probably take this one off. All right. So we have our beginning balance of 92K. We have our depreciation expense for that year. And we know we bought new equipment. So by definition, we know that for sure, we should have our total value in equipment for that year, right? For our total value for equipment for that year should be equal to 92K plus 31 minus 31. So it should be equal to 92 grand. But the thing is now is that we obviously know that there should be a more of a nuance here in terms of just the depreciation of the previous years, right? So that's what we're trying to figure out. I'm trying to make sense of it in some simple terms. Let me see. If you guys can give me just 2 minutes. Give me a sec. Oh, sorry guys, I forgot some. That's what was my mistake. See, do you all remember? Can somebody tell me what was my mistake? Just for fun. Somebody tell me what was my mistake. Can somebody pinpoint my mistake? What's something that I forgot to do? Does somebody have an idea what it could be? And I'll show you in a sec. I got a little bit too excited. Somebody tell me what it could be. No? Well, one thing that I did not add, that was a big mistake on my end, was this idea of the depreciation expense we made this year. That's something that we need to add back as well. And that amount is of 17,000. So already there's something that we're missing. And the way I would do this is I would probably divide this into 2 buckets, because as we could see, we can't add depreciation expense and we can't add all of these different things together into one place. So how I would recommend doing this, and I'm sorry about putting you guys in error there, is you could actually divide this into 2 distinct T accounts. One for your accumulated depreciation, and then one for your general equipment, I guess. So you could do this. Sorry about that. So now if we go back into it, let's restart. And I have 3 more minutes. So what's our beginning balance? Let's go back into it. What's our beginning balance for our equipment? You guys already had it, but I'm gonna ask you again, just so we can be on that group. Okay, so we have 92,000. Now, what's our beginning? What's our ending balance? Nice, cool. So we have 82K. Good stuff. Okay, so one thing that we need to add is we need to know that we have our new equipment. We purchased new equipment of equipment. How much was that worth? The purchase of new equipment. 31,000. Cool. So already there, we know by definition that these two, this is not balancing. So for sure, there's some equipment that was gone. Can we all agree to that? There was for sure some equipment that is gone. Yes or no? Cool. So we want to find the value of equipment sold. Okay, we want to find that value. So this is really simple. You could just look at it from the equipment perspective, not even mixing things together. So can somebody tell me by how much, what is the value of that equipment sold? Can somebody tell me how that would go? Can somebody tell me what that value is? And just to help you out, we have 92,000 plus 31,000, and we know it's supposed to be 82,000. So Leandra, you are correct. The amount is 41,000 because that's what we're missing. If we do 123,000 minus 41,000, we get exactly that amount, 82K. So that's when it balances. Is everybody okay with that? That the value of equipment sold is equal to 41K? Yes or no? Yeah? Daniela, Juliana, good? Does that make sense? Okay. We were just trying to figure out how to balance this specific little thing. We just want to balance this, right? This is what we tried to balance. I think we're fine with that. The thing is, though, is that we're not only trying to find the value of the equipment sold, we're trying to figure out, well, of that equipment sold, how much are actually proceeds, right? What is the proceeds of that equipment sold? The thing is, as you can see in this question, they didn't give us the net value of equipment. They also added what we call the accumulated depreciation at the very bottom. So for us, what we're going to need to do is we're going to need to figure out, well, what is the depreciation that is linked to this specific sale, let's say. So what we're going to do is we're just going to make sense of it. We're going to look at this specific sale and we're going to try to make sense of what's going on. So we want to figure out how much accumulated depreciation, right, has actually been sold off by this. So in order to do this, we're going to look at our beginning balance. We're going to look at our ending balance. We're going to try to make sense of all this. So just to be sure, let me look at a few things. So let me ask you, what is the beginning balance for accumulated depreciation in this case? What do you think it would be if we go here? Do we agree with Leandra? Amazing. Yeah, it would be 15,000. Now let me ask you, by the way, for a T account, it's okay. You don't need to put negatives. Just kind of leave it as is. What about the end balance? What would that be? What would the end balance be? Nice. Okay, cool. So now we have that. But what's cool is that when we're looking at accumulated depreciation, we could actually also look at the depreciation expense we had this year, right? Because accumulated depreciation is literally just us adding our depreciation expense every single year. Now, does that make sense to everybody? Technically, we should have this amount plus our depreciation expense, and that should be equal to this amount. Does that make sense to everybody? This plus whatever this is should be equal to this. Exactly. However, it's not the case. Well, we don't know yet. Could somebody tell me what's my depreciation expense for this year? What is that? What is that number? If you go look at the statement of income, $17,000 exactly. Now, obviously, this is not the same because this is equal to a different amount, right? This is equal to essentially $32,000, the sum of these two. So what are we missing? How much are we missing? What would we need to balance this equation? Somebody could tell me. 1,000, exactly. So we could actually just call this the accumulated depreciation that was sold off with this equipment. And that would be 1,000. And for all of y'all that don't know how we did that, essentially, I did my beginning balance plus my depreciation expense minus my ending balance. And that gave me 1,000 because we want to figure out how does this whole thing here balance. Now, before we proceed, does this make sense? Are we okay with this? Is everybody okay with what we did here? Daniela, Juliana, are we okay with this? Cool. Okay, so we have this section and we have this section right here, the good stuff. Amazing. So now all that we're missing is we need to figure out whether there was different things that were associated with this transaction. Were there any gains and or losses associated to equipment, right? That's what we all get back to, because that's going to actually affect whether we actually made cash off that transaction. So as you can see here, do we have a gain on disposal of equipment? Yes or no? Exactly, we have a gain on disposal of equipment. So if we go right here, we know that the equipment sold, we could call it this actually, value of equipment sold is equal to 41,000. We know that we have accumulated depreciation on that equipment of 1,000. And we know that we have a gain on equipment of 3,000. You can even go as far as to say less, and then can somebody tell me what's the proceeds here? What are the proceeds in this case? Somebody tell me in our last minute together. Exactly. It's equal to 43,000. Are y'all okay with this? Does this make sense? Do we understand why the proceeds is equal to why this is equal to 43,000? Yeah, are we okay with that? Quickly, real quick. Does that make sense? Good. And so, Daniela, what is the cash provided by investing activities? What is the cash provided by investing activities? By investing activities. So you just need to add all of these up. Minus 40K, plus minus 31K, plus 15K, plus 43K. That gives us minus 13,000. Daniela, are you okay with that? Is that cool? Oh, no problem. Okay. So I'm sorry, but I really have to leave. Like, it's a really hard 3 hours today, but I'd like to ask two things. One, do we feel okay with today's session? Like, do you feel better off? Yes or no? Yeah? I think y'all were doing really, really well. Like for the second problem, like y'all, we were going strong at it. So I'm happy about that. That's amazing. Two, I'm going to be literally making a in-depth solutions course pack for this. Always 24 hours after, including the recording as well. Okay, so don't you worry. You're going to have all the exposure you need and all the notes. And as you've done already, you can ask me messages all times, and we can even do one-on-ones, whatever you want. So don't you worry. Then three, on Thursday, we're doing our first final exam crash course, and we're going to do another operating activities type of question. So you're going to have even more exposure. All right. So that said, any questions before I go, or are we good? Because I need to leave, unfortunately. Okay. So yeah, hopefully it was helpful, and looking forward to helping y'all on Thursday. And I think you guys did really, 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 really well. I think you girls did amazing. So good stuff. My pleasure, my pleasure. Bye-bye.